Hey everyone, I'm Greg Capper. Today's show, we're going to answer the question, which option strategy is better for profiting from short-term bottoming patterns, buying options or selling options? Stay tuned. This is Master Trader Live.
You're watching Master Trader Live. Simple market analysis and education to help you make money in the markets. Join us live each week on Facebook and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Welcome back to Master Trader Live. Make sure to subscribe by simply typing MT into the comments. As always, I'm joined by Dan Gibby with the team behind MasterTrader.com. Hey Dan, how you doing, buddy?
Yeah, hey, good afternoon, Greg and fellow viewers. We're excited to be launching our new Be Live trading program here. And in this program, you're going to learn a valuable subject every single Wednesday at noon Eastern time. And we welcome your comments throughout. So as Greg said, we decided to do this first lesson because we get emails all the time. You know, we trade anything that moves, stocks, options, currencies, commodities, futures, and people always ask us, okay, here's a bullish pattern. Should I buy or sell options? And that's what Greg and I are going to tackle here for you today.
Yeah. Options are tend to be a difficult subject, Dan. And I mean, I know it was for me, kind of, you got to get your head around it a little bit. It's different than just buying or selling the stock, which is what I've done pretty much my whole trading life. But options just add another, it's another vehicle, another way to make money. And it kind of says different options on how to manage things. And, when we look at the chart, sometimes it appears, we know it's not, but sometimes it appears like it's free money. Picking the right strategy obviously is puts the odds in your favor, and that's what we're going to answer today. So,
well, and you hit the nail on the head in terms of, hey, you see a bullish or bearish pattern, and you're very confident to hit the button to enter it long or short. And so, sure, you need to go through some definitions and get some training in the different option definitions and strategies. But the reason I love trading options is because they're multi-dimensional, meaning we can it's like going to the casino and having different desks out there to put on different speculations. And we're obviously going to cover two of them today, but we can tweak our bias and get paid for it, as you're saying. And that's one of my favorite strategies, is selling the credit spreads. And we literally get paid just by predicting a short-term top or bottom. And that doesn't exist when you buy or sell stock. You're in the driver's seat.
Yeah, that's what I like about this particular strategy with options, because it's relatively simple. So, I mean, I've always looked at options from the point of view of buying calls or puts, a directional way. And, as we look at charts, part of the struggle technically kind of is, okay, is this the perfect chart pattern, so to speak, where I can buy it at this point? I got my stop, which, okay, I'm going to give it some leeway to move around. But with these credit spreads, I mean, it was like a whole new world, so to speak, for me, looking at it from a technical perspective, because it was like, well, I don't have to be so exact or perfect about it. It can be sloppy, and that's okay.
Bingo. And this is actually a great lead into our two strategies today. At Master Trader, we divide our option teachings or approach, if you will, into two simple, buckets or categories. One is directional, and then Greg is saying a directional is just buying the stock, which it obviously is. And then we teach directional option strategies. Bucket number two is what we call an income strategy, where we're profiting from these short-term tops and bottoms and literally getting paid for it. So why don't we take a look at this TLT chart, and let's jump right into this exciting subject.
Yeah, and Dan, part of with options, there's always some kind of struggle. Nothing is, sometimes we look at stuff and it is a no-brainer. Kind of how we talk about, those type of setups that are like, wow, appears to be free money. But, when I look at these strategies, sometimes what I really struggle with, what we're going to talk about is, well, how long? You know me, I'm always looking for the one where it's like, let it expire tomorrow. And so when we start going further out in time, it becomes a little bit more of, well, can it really happen? But let's take a look at the charts.
And you're jumping the gun a little bit on our bull put credit spread, which we'll get to. But let me add one more thing, just to comment on something you said about free money being in the corner. And the reason I just want to address it, because it's an important part of market psychology and the objective approach to trading the markets like Greg and I do at Master Trader. So I personally don't believe in that statement, and Greg doesn't either, but that's why I'm illustrating what it really means. There's not free money in the corner to pick up, because
I struggle with that, Dan. Sometimes I look at it and I'm like, that is free money. I got to keep myself in check.
Okay, so then that's fine. Then I'm speaking for myself. But it was Jesse Livermore who said that in one of his books. But let me just elaborate on what I mean on that. I've been trading 25 years, Greg, 30 years. We've seen patterns and, movies, so to speak. So when something lines up with overwhelming confidence, that's when we increase our share size and we get a bigger payday. Now, that's not a novice swinging for the fence like some novice traders do. It's confidence and executing your trading plan on that confidence. In fact, we can't pull up the charts now, but in the Master Trader Green live trading room this morning, and I'm just looking at my charts here on my other computer, Greg mentioned one of these money patterns called a new low 2-bar reversal, a new low failure. And if our viewers want to take a look at that on their own, you can look at these spiders, SPY, or the Qs, QQQ, 10-minute chart. They made a new low at approximately 10:30 and immediately got reversed with a bullish engulfing bar. I'm sure I'm speaking for Greg, but I think Greg would say that was a picture of money.
Well, yeah, and because for many years I traded that instrument, I got to know it intimately. In a way, every instrument, while the same technical patterns, they do have certain personalities in a sense. So with the broader markets, especially when you're trading the futures, which are leveraged, that making of a new low in the beginning of a reversal in a downtrending day, the shorts start to cover and it can be a violent move. And that's what happened today. So, the markets being up multiple days in a row, short-term intraday traders are going to short the market, looking to profit today. But when it makes that new low, those that are new to trading those instruments tend to short at the worst possible time.
Right. Now, let me answer a question real briefly, just because it's on this subject, and then let's jump in to take a look at our TLT pattern and 2 option trades. And if you're just if you're just tuning in, welcome to Master Trader Live. Today we're talking about, is it better to sell options or buy options on a mildly bullish setup like TLT? But our viewer is asking, do we keep the same risk to reward in every trade? And that's an individual question, but my answer is no. And here's the reason why. For the reason I just said, which is I have different levels of confidence. And when I think there's money in the corner, so to speak, on that analogy, I increase my position size because I'm very confident that I'm not going to hit my maximum stop. But yeah, that's a great subject that we can, spend a whole future session talking about, risk management.
Right.
But yeah, let's take a look at the this TLT chart and jump into our program today.
Awesome.
So this, I actually found this. I mean, TLT is an ETF for the portfolio of primarily 20-year bonds. So we trade all kinds of liquid ETFs in terms of intermarket analysis. We're always watching what the bond market is doing. So this trade that we're going to show you first actually came from another service, another option trading service. And one of our subscribers emailed it to me, and they said, "Hey, Dan, what do you think of this trade? And can you compare it to a bull put credit spread?" And I'm like, "I'll be happy to. I get this question all the time, and that is the subject of today's show." So at Master Trader, everything starts with an analysis of the chart on multiple time frames. And then, as I mentioned earlier, we put it in a directional trade or an income trade. So let me start with asking Greg, who's our master technician for over 30 years. Here's a short-term bottoming pattern. I ask you, Mr. Capra, how bullish are you on this pattern?
So this is one of the things that I love about options. It's like, I probably would not buy this.
Don't jump the gun. I know you're excited.
But how bullish am I on it? Like the title says, mildly bullish, because it has made a bottom. And I know that because as it's marked, it's got a breakdown failure. And we don't know it's going to be a breakdown failure at the time. It's a real breakdown. But when it reverses, this is one of my favorite patterns because, like many things that I've learned over the years, it was about, well, you don't know it's a mistake at the beginning, but it turns out to be a mistake because we measure mistakes in the market by losing money. So when were
you ever in any of those mistakes, Greg?
Well, that's exactly how I found many patterns that I use today. Is that those mistakes cost me money. And so I was like, how do I make money from something like this? And by studying it, a lot of the failure patterns that we use is things that I lost money on years ago.
Well, and I'm just going to add to that for the folks new to Master Trader, that I've been working with Greg 22 years, and he always says these kernels of information. And I've even written like 15 or 20 that I call Capra-isms, because they're just one-line sentences that have so much hidden knowledge. And so sometimes I feel like, I have to elaborate on those for the benefits of others to get the value of that kernel of information. So something Greg just said there kind of in passing was, yeah, I've learned from my mistakes. But if you digest what he's saying is every trade is a setup, is an action, meaning you enter the trade and you manage in between. So when things are not working, Greg is saying he's back at his desk after the market close and he's taking notes and changing environments and he's learning from those mistakes so as not to repeat them. And hence the breakdown failure with a price void above is one of our favorites. So let me explain that. So we have a bottoming pattern, breakdown failure, as we said. How bullish am I on this pattern? It's simply what we refer to as price void is the way the issue came down, fairly hard, and there's not much resistance to prevent a tradable bounce. So yes, this is a short-term swing trade for us because there's a lot of support below, and it should bounce a little bit. That's what the chart says. So now let's take a look at the first trade, which we call a mildly bullish option directional trade.
But I would point out to those that are listening, and guys, if you're enjoying the show, share it on your timeline so others can enjoy it too. But we're saying this is mildly bullish. We could just simply look at the lines on the chart, those moving averages. They're still pointing down. Now, if we were to take this same picture, meaning that breakdown failure, and those lines were pointing up, we would be very bullish. So
correct.
Patterns have to be put in the context of trends and location, meaning is it in an area of support and so on. But so just a further explanation as to why we're not extremely bullish.
Excellent point. And so Jax, let's take a look at the next slide. And then I'll also explain to you in a moment how we could have made this a fully directional. So here, this is the trade that was recommended by the service, which we told our subscriber that it was fine, and then it was up to him, the trader, to decide which of these he liked better, and that's going to be up for our viewer to make the same determination. So it's a directional trade. This is what's called a bull call debit spread. You're buying one call and selling another. What the heck does buying a call mean for those of you new to options? You're going to the marketplace and you're buying a call option contract that gives you the right to buy the underlying, which is TLT, and then for a specific price on or before whenever the contract expires. So the one recommended in this particular trade was 38 days to expiration. That's what DTE means in the heading. And they recommended a $117 strike. The TLT is trading at $118.59. So this contract allows you to buy TLT at below market price, but you're paying for that right. In this spread, you are simultaneously selling a 119 call. What does that mean? It means that you have the right to buy it at 117. You're putting money in your pocket, which is lowering the cost of the 117 call, and you're allowing somebody else to buy your TLT at $119.
So what if it goes to $116, Dan?
We're going to answer that right away. So, so the next bullet here, we're going to talk about maximum gain. So the way I'm going to structure both of these two trades is just having the same format. So I'm going to discuss the trade as I just did, the maximum gain, maximum loss, return on capital, break even, and what I'm going to refer to as the cushion. But let's go one by one. What is my maximum gain on this mildly bullish option trade? I have the right to buy it. So the maximum gain is if the TLT closes above $119 at expiration. So here's your maximum gain. You have the right to buy it at 117. Somebody's going to take it away from you at 119. That's $2 a share difference. You paid $1.16 a share for this position. So the difference of the two is 84 cents a share. Now, one contract represents 100 shares. So if you bought one contract of this bull call debit spread, then you've made $84. If you buy 10 contracts, you've made $840. Now, the max.
So I have to wait the 38 days?
Good question. You absolutely do not. As long as the option markets are open, they are constantly adjusting their prices based upon where TLT is and other option variables, which we aren't going to get into today. But since it's a swing trade, excellent point. That's exactly what we would do. And we're going to actually talk about management strategies on the last slide to finish this lesson today to show you how we would manage it. Because for a swing trade, we're managing when the bounce stalls. And then we would go to the marketplace, the option table, and we would sell to close this bull call debit spread. And the difference would be our profit, whatever we sold it from, less our $1.16 a share cost basis. All right, so Mac.
And when you say if it closes above $119, well, what if it was at $120 tomorrow?
Well, then we go to the option table and you can sell it
and collect the whole thing.
No, you won't collect the whole thing because there's the other option variables. There's still time remaining, so there's time decay in there. So no. To answer the question of how much you think you would make at that point in time, we would have to look at the option Greek called delta. And what that measures is how much I should get paid for every $1 rise in the underlying.
So that's kind of the other side. It's really not a negative, but it's part of trading options is that if I was to just buy this TLT and it was at 120, I would just take my money full.
Without a doubt. And so let me just add to that, because we talked about what if we were more bullish on TLT, like if it were in an uptrend. If it were, you could buy the stock, no doubt about that. But today we're talking options. So what we would do as an option directional trade is we would just buy an in-the-money call. So like this 117 call, that would be the end of the trade. And then when you're selling your stock at 120, I could sell my 117 call at the same time. And I'm not capping my gains at 119.
And only cost you a lot less money.
Correct, because you're capping your gains.
Well, no. I mean, if I buy this, my cost is going to be a lot more than yours using options.
Absolutely correct. And that is a huge benefit. And we're going to come to return on capital in a second here, but absolutely correct. That's one of the benefits of buying options, limited risk, return on capital dwarfs trading the underlying stock.
Okay.
Maximum loss now. Whenever you're buying options or stocks, your maximum loss is what you paid for it. So if I paid $1.16 a share, that's my maximum loss. If you pay $118.59 a share, you have a much bigger loss, potential loss, than I do. Yeah. And that's why we love our directional option trades also. Now, return on capital. How do I calculate that? I take I'm assuming the maximum gain in this case. So it's 84 cents a share divided by my investment amount, which is $1.16 a share. You can see that that's a whopping 72% return on capital. If Greg bought the stock at 118, even if he got a $2 gain out of it, $2 divided by 118 is a whole lot less return on capital. Right. That's a benefit.
Right, obviously. But just so those that are new to options, if this, started to go down, and this is an ETF, so I like ETFs a lot because there you have the diversification where you're not, especially when we talk about biotechs, but you can hold on to this for a very long time, whereas the options that you mentioned before, there's that melting ice cube, and so everything has pluses and minuses to it. But with that loss that could potential, if I own the underlying, I would probably play this a lot tighter. Whereas with the option strategy, and what I like about the option strategy is you don't have to be so tight, so to speak.
Okay, and you brought up a great subject of the melting ice cube, which leads us into these final two bullets here, which is break even and cushion. when you buy options, there's a cost to it. And the time decay is what you're having to pay to the option market, to the option seller, and giving you your rights to buy the underlying. So if the underlying doesn't move in your favor, day by day, the option that you bought is decreasing in value. So that's what Greg's referring to as the melting ice cube, which is going to be even more clear in our second example. But this one, Greg, and our viewers, and if you're just tuning in today, we're discussing the very exciting and subject of when we have a mildly bullish pattern like the TLTs, do I want to buy options or sell options? And since this was only a mildly bullish trade to us, we wanted a cushion, and that's why it's not a directional trade. So what's my break even? Well, what did I pay for the stock, for the spread rather? I paid $1.16 a share. What again does that give me the right to do? The 117 call? I have the right to buy TLT at 117. I paid $1.16 a share for it. That brings me to 118.16 is my break even. But it's trading at 118.59. That's what we refer to as the cushion, where the position, TLT, can go against us at expiration and we still make money. So in this case, we have positive theta, so to speak, but don't worry about fancy definitions. And the reason this is happening is because we are willing to cap our gains at 119 in order to improve our probability of profit. So we have 43 cents a share of cushion. Whereas if you buy the ETF, you have zero cushion.
I was just thinking that.
If it goes up a penny or a dollar, you make it. If it goes down, you lose it. And once again is why I love option trading. So let's jump to the next example now, because now, and I'm gonna jump to the conclusion here, folks, and just put it in your head that these two trades today, but on other shows we'll talk about, analyzing trades that didn't make sense. They were ludicrous, not from us, maybe from others. But my point is that the purpose of this today is to show you two different profitable option strategies where they both have favorable probability of profit, but they have different reward to risk ratios. So let's follow the same format as I just did in the prior strategy. And this strategy is called a bull put credit spread. Credit means money is going into your pocket. And this is the second category or bucket that we talked about at Master Trader, where this is an income trade. We're getting paid just to call a short-term bottom. Greg, what do you think the odds of TLT, I'm putting you on the spot as our master technician, of closing above 117 in 38 days? Just there's no right or wrong answer. Just give me your probability.
Well, I initially was thinking 100% because I know you don't like that answer.
It's your answer. I said no right or wrong answer.
This isn't a no-brainer. And when you say 38 days, that is the real, variable there. If you said to me tomorrow, I would say 100%. Now, because it's an ETF, it's not going to gap down significantly. I would just guesstimate 38 days, let's say at 80%.
Wow, I would have even given it higher than that. I would have said 90, but it doesn't matter. So, okay, so thank you. So you answered the question. So let's now define what this trade is, because you're going to see that I get excited on these trades because when Greg and I walk into the casino in Vegas, Greg goes to the stock booth, 8 out of 10 times. Even though I think I've worn off on him that he loves these trades too, but I'm going to the booth that says, "Hey," and some guy's holding up a big sign that says, "Make money just by calling a short-term bottom." That's what this strategy is. So let me elaborate. When I sell a put, I'm putting money in my brokerage account, premium, if you will, and I'm obligated, as that bottom arrow shows, to buy the underlying at the agreed upon price, $117, on or before 38 days, if the put buyer wants me to buy it at 117. But do you think the put buyer is going to ask me to buy it from him or her at 117 if he can sell it in the marketplace for greater than 117? No. And that's what's referred to as expiring worthless. So at Master Trader, we are experts in picking short-term reversal patterns. We actually prefer 10 days or less because of this melting ice cube, which I'll elaborate on in a moment some more. But we find short-term patterns, we get paid for it, and we want that time decay that is hurting the option buyer is our daily profit. So on this particular example, I am selling the 117 put, and I use the same 38 days to expiration so we can compare apples and apples. If I just left it at that could be fine, but that would be what's called a naked put. I'm just shorting a 117 put and putting the money in my pocket. But in this particular example, we're going to simultaneously buy a lower price put. And we do that for two reasons. Number one, it limits our potential maximum loss in the event of a big gap down against us. And as Greg said, it's an ETF and, I don't think it's going down, et cetera. But that's a reason. Reason number two, it is less maintenance requirement at your brokerage firm to put on this position.
What do you mean by maintenance? Yeah.
It means the buying power consumption. If you were to buy the stock, ETF, intraday, day trading rules, you get 4-1. Overnight, the brokerage firms give you 2-1, which is called Reg T margin. There is no margin in option trading. If you buy, like our prior example, $1.16 a share is pulled out of your buying power at your brokerage firm. If I were to short this 117 naked put, there's a complicated formula, but the easiest way to estimate that is just take 20% of that 117. So in essence, I would be getting 5-1 margin, and you as a stock trader are only getting 2-1 margin. But in this example, I'm simultaneously selling the 117, buying the 110, and I'm taking in 81 cents a share. So if I sell 10 of these credit spreads, $810 immediately hits my brokerage account.
This is sounding like a better trade.
Well, and as I said, it's going to boil down to the individual trader, but I agree with you. And we'll see if our viewers are going to agree also. And if you're just tuning in, welcome to Master Trader Live. Today we're talking about, is it better to buy options on a mildly bullish trade or sell options? And we're very clearly going over the different reward to risk ratio, and we'll let you decide, the viewer. So the maximum.
And the other one, just looking at what we have here, the other one made more money.
Well, it only made 3 cents more a share.
Yeah.
And I'm gonna mention something right now. I'm jumping the gun a little bit. You will only make 3 cents more a share, Greg, if the stock rallies 41 cents.
Okay.
And I want everyone to really understand that. If the TLT goes nowhere, you are only, and let's say it closes at this exact penny at expiration. Example number 1, on the debit spread, you are only going to make that 43 cents cushion from selling the out of the money call. So on a 10 lot, you're only going to make $430. This trade, I make $810. So very important distinction there. Okay. What's my return? What's my return on capital? It's going to be a whole lot less in this case, but I have a much, much, much higher probability of profit, which you'll keep seeing. But here's the math. 81 cents a share. My requirement at the brokerage firm, since there's no margin, remember, they take the difference of the strike prices. So 117 less 110 is $7 a share. But I already put 81 cents in my pocket. So this one's costing me $6.19 a share to put on this position. But keep in mind, folks, when you look at these return on capitals, this is 38 days. How many people would be happy making 13% in an entire year? And we're doing this in 38 days with a high probability of profit, and the stock can go way against us. Let's now take a look at our break even. So in this case, this is the juicy part, the break even and the cushion. How do I calculate break even? Well, let's go back to what I said at the beginning, which is the bottom right words there. When I'm shorting that put, what are my legal obligations? To buy the stock, the ETF, at 117 a share. Okay.
That's not so bad.
How much did I put in my pocket on day one? 81 cents a share. Folks, this can go down to 116 and 19 cents at expiration before I start losing money. Well, before I will lose money. What's my max loss? So this is going to be a big difference in the versus the debit spread, but I'm going to explain to you why it's of no concern to me. Max loss on any, the max loss on a credit spread is if the ETF closes below my lower strike. So in this case, my lower strike is 110, right? So I would incur a $6.19 loss if it closed below my lower strike. So how much would Greg lose if he bought the ETF at 118.59, where it is now? How much would Greg lose a share? You can't talk back, but I know you're answering in your head. He would lose $8.59 a share. So selling options by definition I have less risk than trading the underlying. Now let's look at my, also on the max loss. So Greg, where would you stop out of this position? I know you said it would be a little bit tighter if you were long the stock, but let's just call this a regular swing trade. And where would you put your stop?
Well, that really kind of opens up a couple of different things as to how to handle it, Dan, because, from the option trading, the bull put spread point of view, with this kind of a pattern, I would be okay putting on the position right now. Whereas because it's just a mildly bullish setup, I would want a little bit more confirmation and probably would pay more for a little bit more for that confirmation. And I would most probably put my stop under that little tail bar prior to the green bar. So I wouldn't let it go all the way down. So I would incur whatever my calculated loss would be sooner. I wouldn't be able to play it as tight. Well, I could, but if I share size it smaller.
Excellent point. And that just highlights another benefit of income trades, selling options and putting money in your pocket, versus directional trades, because you're going to get hurt more in the directional trade if you stop out. But the other very important part I wanted to mention, and you cannot focus on the maximum loss because it's not realistic. More realistic is, what will my loss be if I get stopped out on this pattern? And so my stop on this trade is under that lowest low on this chart, because that's where we sell these puts, is under major support at Master Trader. That's our strategy. If it breaks support, we're out of it. We're going to take our stop and move on. But secondly,
Dan, I just want to, everybody, if people are new to this discussion might seem a little complex. It takes a little time, but I have to kind of promote Dan's prowess. I was thinking with options that I know what Dan would be doing if this was going down. He'd be selling a call spread above that and taking in more money.
Correct.
So, that's beyond the scope of this discussion, but some of the things that I've learned from Dan and the management of options is an incredible subject.
Yeah, awesome. Yeah, and Greg and I just work so well together, combining, chart analysis with option analysis, and that's our expertise. But in our experience, a more realistic stop out amount based on the way we manage per the charts is not $6.19 a share. It's 2x of the credit received. So we took in 81 cents a share. If you wanted to proper share size it, assume twice that or even 3 times that. So twice that would be a loss of $1.62. That's a far cry from the $6.19. So yes, we're always focusing on proper risk management and proper share sizing, but do not focus on the spread width, because that would be akin to Greg saying, or anyone saying, Greg wouldn't say this, but it would be akin to saying, well, I can't buy the ETF at $118.59 a share, because if it went to zero, I've lost all my money. And that's just not a realistic assumption. You have to look at your realistic stop out. And so anyway, so the cushion on this one, if we can go back a second, just Jax, because this is a really, really key point, folks. The cushion again, to be wrong, which is our time decay benefit of ETF going against us. In the prior example, it was 43 cents. Look at this massive cushion we have in this strategy. The ETF is at 118.59. It can go all the way down to 116.19, which we talked about was our break even. That difference is $2.40. Imagine Greg walking into the casino saying, hey, I'm interested in buying TLT, but will you let it go $2.40 against me before I start taking a loss? The guy's going to kick you out saying, what are you smoking? But this is the trade that exists in selling put spreads. We're putting on a 10 lot, $810 in our pocket, brokerage account, and it can go $2.40 against us at expiration until we start losing money. So
I want to change my opinion as to the probability of this trade to 90%.
Okay.
117. Now I've got an extra almost $1 to be wrong.
Yes,
that's
absolutely.
An awesome trade.
Oh, absolutely, and we did it. So, Jax, now let's take a look at, and we'll finish today's show with looking at, and so I grabbed the chart all the way to the 38 days of expiration. And so I should have put an arrow, where it was, but that's fine. So what you compare it on your own, you can see where we entered this trade. So the directional trade went up 3 bars, came back 5 bars, went up. So depending on your trade management method, if you remember we talked about selling to close your debit spread based upon the charts because it's just a swing trade, it would have been a profitable trade had you used proper risk management and sold it, using the charts. Oh, thanks, Whiskey. That's very nice of you. Now, at expiration, though, and I put in the heading up there, it closed at 118.46. Remember, it was at 118.59 when the day we put it on. So it actually closed 13 cents below where it was the day we put this position on. So I have a question, everybody, that you can answer on your own. Did the debit spread make money? Yes or no? You can get out a pen and do your own math. The answer is yes, but nowhere near what your maximum gain of 81 cents a share was. Remember, our break even was 118.16. So the difference of these two numbers, you only made 30 cents a share. Now, the bull put credit spread, remember our line in the sand, 117, provided we did nothing and it closed at 118.46, what was my maximum gain on a 10 lot on that trade? Answer, my full premium, $810. Now at Master Trader, on this chart, I'm, just candidly, we would have not have made the maximum, and here's the reason why. Because we're in management mode and we're raising stops, we're taking partial profits at 50% of max gain, maybe at 80%. But when this, depending on how much time was left and how far away it is, we're in total management mode. But the conclusion is we would have made a lot more money on this selling the credit spread, depending on where you got out of the debit spread. But I love selling these credit spreads because we get money in our pocket, calling a short-term reversal on the pattern, and we're getting paid day by day through this time decay. Yeah. And so, Greg, now,
I'm sure how do you would have been highly profitable at the beginning of April. I mean, can you just kind of spitball how much you would have, that debit spread you could have made by just getting out of it then when it was at 122?
Yes, I could. So here's the answer. we were short the 119 call, and if it's at 122, that means it's $3 in the money now, which means, remember, you have to give your stock up at 119. You have the right to buy it at 117. So you could probably close it out. So excellent point. And that's why I said, depending on how you managed this position, you would have some time decay left, which means you aren't going to make your full profit. But being $3 in the money, my guesstimate is you probably could have sold it for maybe 75 cents, 72 to 75. Correct. So then that's exactly how we swing trade debit spreads. We don't hold anything intentionally to expiration, but definitely directional trades. We trade them per the charts. We enter per the chart. We exit per the charts. And on the credit spreads, like you said, we can give them a little more cushion, or stop, just to bounce around and do nothing because we're getting paid through time decay. So both of these ended up being profitable trades, and I hope our viewers now can see, wow, yeah, this is, these are very clear analyses of the different two types of strategies.
Yeah, that was great, Dan. I
Awesome.
always like hearing your explanations of all of these different strategies, and I actually enjoy picking your brain and putting you to the task of explaining it because I'm interested to know. And I was some of our subscribers and even listeners in the chat room maybe don't want to ask certain questions. Everybody kind of, well, I don't want to look like whatever. But I just love to press you on these different things. And when I ask you questions in the room, and that's part of the great thing about our room, we call the green room, is that Dan and I have these conversations and go back and forth as to different strategies and why we did certain trades. And, these options discussions are awesome.
Yeah, and I see we're out of time and we missed some questions, but yeah, please, and everyone, feel free to post your questions, and we can get to them either live or we can even get to them afterwards. Thanks everybody for the positive comments. Yes, this was our first show. We're excited about it. We have thank Jax on the back end. He's kind of our the guy pulling the strings in the back there. Thanks for your help there. And we look forward to every noon Eastern time on a Wednesday. We're going to have another exciting subject of whether it's stocks or options or anything financial that we know would be of educational and hopefully profitable benefit to everybody.
Awesome. Thanks, Dan. I hope you all enjoyed the show. Join us next week and come back and share our page there. Everybody can enjoy the shows in the future. Awesome.
You're watching Master Trader Live. Simple market analysis and education to help you make money. Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the show when you like our page on Facebook. Just visit mastertrader.com. That's mastertrader.com.